One thing that we've been tracking on NDTV Profit is how there's been a shift, a kind of a thematic shift in the way in which valuations are done nowadays. From P&L statements, looking at just earnings, people have started looking at balance sheets, looking at debt, looking at cash flows. And that is why understanding balance sheets has become important. But as I said, that for most of us, it looks like it's Greek. It's written in Greek. It is Greek. It's difficult to understand. For that, I've gotten one of NDTV's in-house finance wizards, and that's Ritika Jain, joins us right now. Thank you so much, Ritika, for coming in. You know, balance sheet, difficult to understand. Unless you've done accounting, and many of us haven't, you suddenly see, oh, what is this? What is written down? And you switch off. But it's not that tough, right? So which is why I want you to take us through a starting point. We're going to do a series, a dummies guide. What is a balance sheet?
So before we actually do what is a balance sheet, I just want to say that accounts is actually a language of a business through which we communicate that what is the financial performance of a company is at a given point of time. And these are actually done through the financial reports, which we all popularly known as financial statements. So the three prime financial statements to start with, first is the balance sheet, which is actually a statement of position at any given point of time. Then you have a statement of performance of a company, which is actually done by a P&L statement, also known as income statement.
Which is the flow.
Which is the
It's like saying that I have so much wealth in my bank, that is a balance sheet, and I have borrowed so much, but the flow is the income tax return that I... All right.
And then basically we also have the cash flow statement, which is also very crucial because it actually tells you that how the cash is flowing, how the money is coming in and how the money is going out through the year. So basically, coming back to the balance sheet, I mean, I know that, you know, all the financial statements of a company, it has massive amount of data, and I can understand that it can be intimidating for any non-finance person. So I just want to say, if I take a simple example, that, you know, going away from the financial statements, we actually have a balance sheet in our day-to-day life. So if I just quote one example, for example, we need to buy a house. So for instance, if I today decide that I need to buy a house, I obviously would have some capital in my hand to go buy a house. But then obviously it won't be sufficient to go buy a house. So I approach a bank, and thankfully bank agrees to give me a loan. So I actually club my funds and the bank's funds, and I actually go and buy a house. So the money that I actually put in from my own capital is nothing but the equity.
Okay.
The money that I actually borrow from a bank, obviously with the interest rates involved, because and it's a loan because it has to be repaid at some point of time, it's nothing but a liability. And the usage of that funds that I actually do, I deploy that funds to go buy something which is nothing but an asset.
Okay, so that's the house is the asset, and the money that I spent on it is part equity, which is my own money, the cash down sometimes, and the EMIs that I'm putting in is the liability part.
Right,
all right,
absolutely.
Okay.
So I think if we just use these three financial crucial elements in a balance sheet, which we actually is nothing but we actually use them in our day-to-day life, we can actually understand any normal financial statement. I know going by the difficult technical jargons, but these are the three preliminary elements of a balance sheet that, and that's how the accounting equation also is, that you know, we have liabilities plus the equity that the owner puts in, and where he actually invests that funds, basically either to deploy in terms of the operations of a company or the fixed assets, that's where it equates to. So that's why all of them balance.
So generally the difference between a consumer, I know that an asset can be productive, and a business would be that they think to grow, right? And I might buy a house to stay in it. So I consume it, and they would actually be putting it in to grow. So that would be the kind of difference.
Exactly. So that's a basic difference, that they're actually putting or investing. In fact, that's why the investors are investing in the money, because they see there's a future potential in a company to grow. So you actually deploy that funds to grow a company in a certain way.
Okay. Now take us through that. I know you said assets, and I'm going to take all of these first simply. So just take us through what an asset, liability and equity is. You did mention it, but a little bit, and then a little bit in more detail all of them. Right.
So if I just pick up the asset to start with, so asset is nothing but anything which is tangible or intangible. When I say tangible or intangible, it can be a physical use or it cannot be seen physically, and something which can be actually used to productive use, which has an economic value. One thing which I want to
give me, you know, I did speak to you earlier, and I saw what you've written, and we have the graphics out there about what assets are. and you'll see then that the intangible assets. What is it? Give me an example.
So intangible assets are something which is the goodwill of a company that it has actually earned over a period of time, or the IPR. So it actually depends on what industry you are in. So
The brand.
Yes, the brand
Okay.
and everything. And the tangible assets will obviously be the cash or the bank accounts that you have, and the accounts receivable, which is basically anything which can be of economic value and which you actually deploy in terms to
So
actually.
suppose I go and buy a company which is essentially driven by human resources, right? And there's a value given to those human resources. Is that tangible, intangible? What is it?
See, honestly speaking, human resources we don't consider as an asset,
Asset
though.
at all,
Yeah,
okay.
because though, as you rightly pointed out, it should be an asset because those are the people who are actually doing.
So
but
the
that's-
valuation differential will be put in as
Yes,
goodwill?
yes.
Okay, all right, okay. All right, give a little detail. You did mention those.
Yes. So one thing I just wanted to point it out with respect to the assets is that it does not depend on then who owns that asset. So, for instance, as I go back to my same example of a housing loan, so I did buy an asset, and there can be a possibility that, for instance, it would have been 100% financially leased, but it doesn't happen in our scenarios these days. But in that case, I'm not putting in my money to buy an asset. It's somebody else, or the loan, or the investor who's
So
putting in that
technically the
money.
bank owns it.
Yes.
But you control it.
But I
You own
control it. So
yeah.
what is more important is the controlling power that I have, and the possession that I have is actually which makes it from a financial statement an asset, and it actually sits on the asset side of the balance sheet.
Okay, all right.
So-
And there are other things that you pointed out that we have them on your screen, and you can look at them as we speak. And there are things like account receivables. Now,
Yes. So accounts receivable is something like the people who actually owe us money, in terms of that we are yet to collect that money, but we haven't collected it, but there is a surety that the money would come in. So that's also as an asset. So just like we give our suppliers some of the credit period, we also do enjoy, because of our credibility, some of the credit period by our people. So that's the
Alright.
money that we get in. And then we also have, so in a simple example, then the investments that we make, apart from the operations that we obviously run to run a business, there are investments that we make, and that investments would also be accountable as an asset. So basically, whatever money that you actually get and you deploy that money to any use or economic value to gain value to a business would actually be considered as an asset.
sometimes we see inventory. Now, inventory, if it is unsold, is still an asset on the. Oh, is it because
Yes. So if it is sold, it is not an asset. But yes,
Ah.
if it is an unsold inventory, that's obviously an asset. And
So the
especially-
when the inventory is sold and the money comes in, it will go into the cash part of the
Yes,
equity
yes.
side
So
or the earnings
basically-
part.
Yes.
And the
Obviously.
inventory would be, how is it valued?
So it's basically there's a valuation matrix to it. So basically, it's actually cost to market price, whichever is lower. So that's a separate.
Okay, we could do get you back on valuing
Yeah.
and all that FIFO, LIFO. Is that in
so all
inventory?
that is technical jargon.
Okay, first in, first out, last in, last
Yes.
out. All right. We are going to ask you to give us more details about that later on. All right, liabilities.
Okay, liabilities. If I just have to say, it's in a normal scenario, it's like your credit card payment. So
Okay.
all the money that you actually owe to people, the money that you need to give to people, is your liability. So all your telephone bills, which you actually get to pay later. So from a company's perspective, your liabilities can be long term, depending on the loan that you've taken, and also the short term, basically on the kind of loans. Again, so again, the current
And also the bills that you have to
the
pay.
bills that you have to pay.
Okay.
So essentially speaking, it would be actually the account payables, the taxes that you need to pay. So again, as I said in the debtors, the money that that you need to pay, and you actually get some credit period to pay that money, but in your balance sheet you need to show that it's still payable from your perspective. So that's why you show it as liabilities. So essentially speaking, that's the money that you actually owe to the others, which goes and sits, which is the
Okay.
third party money.
The final part of that is, of course, the equity part. We spoke about assets. We spoke about. What's the difference between shareholders' equity and owners' equity? Is it
No, these
the
are
same
just
thing?
technical. Yeah, it's almost the same thing. It's just the owner's equity is something that the owner puts in the money, but the shareholders' equity can also be the other people. Like if you go and buy a stock, so you also become a shareholder of a company. So that would essentially be a shareholders' equity, but that all be, essentially speaking, an equity. At the same time. So equity is nothing but the money that an owner puts in and can be taken out at some point in time. And if I reverse the equation, if in case of a situation, if I need to liquidate a company, all the assets, if I get to sell it, I obviously need to have a liability to pay my third party people.
Yeah.
And once I pay that, whatever is left for me in the last is what is actually the owner's equity. So that's how it is. And the
But the cash accruals that come in, that I hold, come in the assets part.
yes.
So sometimes we see that all the net dividends, where would that come in?
Yes, so I was just coming to that point. So at times, obviously, companies growing and companies making profit. So there can be one situation where the company or the shareholders decide to distribute that money, because that's where the shareholders' stake lies, in terms of to divide that profit amongst them as dividends. But there can also be a call that they take because they see that there's a future potential in a company to grow, that they actually put that money back as equity, and which is essentially called retained earnings. So the earnings which are retained. So that also forms part of the owner's equity.
Okay.
The reason being, it essentially belongs to them, but they're just pooling that money in to invest in the company because they see the future potential. So they actually defer the dividend payment or something. So that's the call that you can take.
Okay, before I move on to, we are going to discuss about the fact that this kind of accounting system from the market's perspective, because the markets are always forward looking, tends to be a little backward looking. It tends to give you what has happened, but doesn't tell you what has. Some people argue that's not true, because from looking at the debt and looking at the liability, looking at the investments, you can actually tell about what the markets, a company is going to do. Give us an example how you would read a balance sheet to be able to make to make a prediction of what is wrong with the company.
Right. So just before I answer that question, I just want to say, like, when we talk about assets, the liabilities, the balance sheet, so it all has to balance out. It's a give and take relationship. I mean, in olden days, we used to have a barter system. Like, it's like we, even if the owner is putting that money into the company, it's obviously they're expecting that the company would give them something in return.
Yeah.
So, I mean, in fact, there are a lot of times when the people ask that why the balance sheet needs to balance. The reason being, I'll just take a simple example that if you go to a coffee shop, you actually buy a coffee. So what you debit is coffee, and what you credit is actually the money that you pay to a coffee shop. Or for instance, if you go for a jog, what you debit is the health benefit, and what you actually credit is the time. So I'm saying the two sides of a coin. So every situation, obviously, if there's an action, there has to be a reverse reaction. So whenever anybody is investing in the company, there obviously there's a potential, there's a scope to obviously earn. Having said that, from a shareholder's perspective, and they're trying to value a company, as you rightly said, the money that's come in and it's been deployed to a certain extent, there's certain investments that's already being done. And so when we do all these ratios to value a company, at some point in time, we can actually see that whatever money that came into the company, whether it was deployed and whether the earnings that was earned, it was in excess of the cost of capital. Having said that, we do need to see what is the future of that company.
Right.
And there's a potential to see that from the growth assets of a company, that what are the future investment that company needs to do.
So I'm going to come to that a little later. I'm going to indulge me and stay for 4 more minutes. Before we come to that final point, I just wanted to know that when you look at it, one of the arguments often made against accrual accounting is that when you have when you buy a company, you get goodwill onto your books, and this same thing that you do doesn't show up at all because it's not mark to market often. Is that a problem?
No, not really. So when you value a company, you actually value a company in terms of what the company is doing, in terms of, I mean, there are a lot of factors involved when you value a company. It's not just whatever is there on the balance sheet, honestly speaking. It's much more. You need to read through the balance sheet to understand that. And what you need to see that what are the future projections of a company is.
I'm talking about book value itself, because you essentially, let's say you're making cables, and all your assets are at at the price that you bought. Then you go and acquire a cable making company to advance it, and you paid an extra. The difference between the book value is added onto your books as goodwill, right?
Yes.
And suddenly it...
See, that's because you actually earned that. I mean, when you in fact, one of the ratios actually takes the book value and actually it compares it against the earnings. The reason being that the money that was given to you was at a certain book value, and what you actually did that with that money to earn that earnings on it.
Okay.
So, in fact, one of the ratios, which is return on capital, is actually the earnings over the book value of the shareholder's equity. It's a
This is just a teaser. For our viewers, I want to tell you that this is a teaser. We're doing this entire series and you will hear about these return ratios, and Ritika will be here with us. The final thing that we want to discuss, as we were saying back, there is Ashwath Damodaran talks about, looking at the financial balance sheet, which he calls, which is looking at growth assets and assets in hand. Just take us through a little bit of that, and then that's going to be the next show, though.
Yeah, sure. So as I was talking, so again, I mean, we talked about equity, we talked about liabilities, but the asset side can also, there's another angle to it which actually can be seen as a investment that has already taken place at the point in time that when you valuing a company, and the growth assets. So by growth assets, we would mean something like a shares or something. So basically, which has a potential to run excess returns more than the cost of capital.
Okay.
So that's where I think there's a main angle to it in terms of valuation that we need to understand what's the future projections of a company. So if I just take an example of an e-commerce, I mean that's the rage these days. All the e-commerce companies obviously has got
Only
investments
growth
coming in,
assets.
and yes, absolutely, that's what I was coming at. Only growth assets in a way, and these being companies are valued at amazing valuations. So what is it that actually the investors or anybody who's valuing those companies are looking at? They're actually looking at the growth potential of that company, and the expectation is that the earnings would at some point of time would be much more than the cost of the capital that they're putting in now. So that's where I think it's very important to see that what is the growth potential of the company, apart from that what is the company has been done so far. In fact, all these valuation models do take these projections into play when they're valuing a company.
All right, Ritika, thank you for coming in. We're going to focus on this financial balance sheet because it is perhaps a more useful metric, useful kind of thing to look for in the markets. We're also going to get you back to give us a little bit of idea about INDAS because that's really created a lot of confusion in the markets in terms of predicting quarterly earnings.
Right.
And I think it's going to continue for the next 3 quarters. So we should look at it as well. Thanks a lot,
Thank you
Ritika.
so
Pleasure
much for
having you
having me.
here.